Most of you have seen, I do a little chart where I take $1 and I double it, and I double it 20 times and it becomes $1 million, but that's without taxes. If we were to pay taxes all the way along the line, let's say I've got reduced rates of only 15%, that $1 million, I buy and sell, buy and sell, buy and sell, buy and sell, and after 20 trades, instead of having $1 million, I've got 220,000. And then we add in state taxes, and some of you are going to end up with the same amount of work, but instead of having $1 million, you've got $49,000 because you didn't understand the tax game. You were paying capital gains taxes at every turn. You were paying other taxes, and the best way to create a good retirement plan is to use the tax advantages that the IRS or the Congress has given it. And so we like IRAs, we like buying and selling within retirement plans. And so use those and maximize those. Whenever the IRS, whatever Congress gives you a free road and a way, an avenue to avoid the taxes, it's something that you ought to seriously consider. Not saying that retirement accounts are for everyone. Maybe they're not. I see a lot of successful real estate investors that are just buying and selling. They're doing it in their own names. They're using LLCs. They're creating wealth. But if they were to do that same activity within retirement accounts, oh my gosh, it could grow exponentially faster than if they're paying taxes at every turn.
How do taxes work when your IRA partners with a non-IRA partner on a rental property? Is the partner responsible for 100% of taxes, or just they report and pay their taxes by percentage of ownership in the investment?
It would be a percentage. Let's say, again, your IRA contributed 40%, you contributed 60%. And it would be very much like, so whenever the rent comes in, 40% goes to the IRA, 60% comes to you. Whenever a tax bill comes in, the IRA's got to pay 40%, you pay 60%. You can't play with these numbers. When it comes to taxes, 40% may be tax-free or tax-deferred, depending on what it is you're doing. But yes, you would end up paying taxes on the other 60%. And again, we can't change that percentage. It would be nice if eventually you could buy out, or the IRA could buy you out, but we can't do that. But on the next investment, maybe there's more money in there in the IRA and it can buy 80% or 100%. We're looking eventually to be able to do all of our real estate transactions, all of our stock market transactions inside of self-directed, retirement accounts. But the problem with them, as you know, is the contribution limits. If you're under 50, you can only contribute $6,000. And so getting money in might be the problem. I had a really good year, but I could only contribute $6,000, $7,000 if you're over 50. But then look at other plans like SEPs and Simples, and look at 401ks. Look at other options. I'm having a business. I'm taking 25% of my salary and putting that into a self-directed retirement account. Look for ways to contribute, because some of those you can contribute up to $57,000, $58,000 a year. That's a substantial difference if I can start putting that much money into retirement accounts and letting the retirement accounts invest for me.